First of all, the Russian economy, when we look at it from the outside, we see a very healthy balance of the aggregates. Looking at the current account, looking at the budget, looking at the low levels of debt relative to exports and relative to GDP, it looks to us from Switzerland a very attractive combination of macroeconomic factors. And we do look this year for a pickup in consumer spending and in growth for the Russian economy. When we look at Russian assets, and in particular equities, we see one of the cheapest markets that we can identify looking across the world. The discount in terms of the ratio of price to earnings for Russian equities is around 45% as compared with the index of global emerging markets. That we think is attractive. We think the investors globally are underexposed to Russia. There has not been any real flow of assets into the market. It has begun to pick up, and we think that pickup continues. We would look for Russia to be outperforming emerging markets and outperforming equities globally, thanks to the combination of good fundamentals and very, very attractive valuations. It takes time from monetary easing, from liquidity injections, for that to translate into economic growth and better conditions for banks to give credit to the private sector. In the US, it took 2.5 years to see a pickup in bank lending. So the impact on the real economy is there, but it takes time. The ECB, at the end of last year, with its longer-term refinancing operation, repeated at the end of February, has created the conditions for the Eurozone to experience the same improvement in credit conditions in due course as we're seeing now in the United States. So the impact in the interim, until we see that improvement in the economy, we think shows up in asset prices. You mentioned commodities. We think the outlook for commodities is positive, but we think the outlook is even more positive for equity markets, which will begin to anticipate the pickup in real GDP growth, which we see coming. We have the cumulative impact of everything that's been done since the global economic crisis in 2007-2008. And we do see that central banks will maintain that very accommodative, very aggressive monetary policy setting for as long as it takes for the real economy to pick up. So even if we see higher energy prices, even if we see higher food prices, and we do believe we will see those, we think that the central banks will continue and will not stop until they're satisfied that the economic recovery is self-sustaining.